Sofi stock. Sofi stock is the only one I'm reacting to and talking about in this video here today. Anthony Noto was interviewed by Cathie here, and I think this is an interview that everybody should see. I want to share my opinions and perspectives and point out some big things that were talked about here in this interview. In the back half of it specifically, that's when it seems to get much more interesting. So I just want to jump straight into this, guys. Appreciate y'all joining me as always. Thank you for smashing that like button. Make sure you subscribe to the channel. If you're not already subscribed, we're at a new all-time high subscribers. And also I got a free brand new workshop for you guys. This one goes into how much money do you need to retire, quit your job, those sorts of things. It's a question I get a lot. And so I thought, let me film a full little workshop around this. So if you want to access that, it's absolutely free. That'll be the pinned comment down there here today. I hope you guys enjoy that one, okay? All right, so let's get into this.
Two of the largest banks in our country go out of business, both in California, both technology oriented. I mean, Hank Paul used to say, your house and your street is only going to be worth what the other houses on your street are. And so to be in California, in the same region as these other two banks, technology oriented, you know, it definitely raised the level of scrutiny and the level of care that we have to bring to the table every day. And the team's done a great job navigating it, but it's definitely was what is absolutely not expected.
We're still seeing demand deposits leave the banking system. Has the psychology shifted from, scrutiny to, more trust? And are you actually becoming a beneficiary of this?
You know, we've been a beneficiary, but not because of anything other than the design of our product. And, in fintech, there's not a lot of talk about product design and product market fit and the application experience, but those are huge differentiators for us. And I'm actually glad no one talks about it because they don't understand how important it is. But we architected our digital wallet, or the equivalent of a checking savings account, SoFi Money. We architected it such that the value you get will only be unlocked if you're willing to make us your primary account. I do direct deposit with us. So our 4.6% interest is really high, but you only get that if you do direct deposit. You also get no fees, you get reward points, you get a free certified financial planner. You can pay your bills any way you want.
Okay, so this is a huge point right off the bat here. Okay, so I was considering moving a substantial amount of money to SoFi to earn that interest rate, right? But they do not allow you to get that 4.6% or anywhere remotely close to it unless you have direct deposit set up, okay? So this is good and this is bad. One, it obviously encourages people to have direct deposit and, so they can get that 4.6%. That's good. And you want to, the holy grail is always having that direct deposit being the main banking, product for folks out there, right? But the problem here, and this is, it is a problem, okay? Guess what? Now they can't win me over personally as a customer, right? Think about it. If instead I'm going to do my business with Goldman Sachs, I'm going to do my business with Ally, Chase, and others, because I want my, a 4% plus number, because I can get that from several other institutions. Can't get it from Chase. I can actually get a 5% number from Chase if I do a 2-month CD, because if you're in like the private wealth thing, you get like 5% 2-month CD, and you can kind of just keep, renewing that. But the issue is they're not even going to be able to get a relationship with me, right? If they had offer something like that, let's say, okay, you can also get 4.6%, not just with direct deposit, but let's say you deposit $100,000 in, something like that, right? A lump sum. Okay, then we can build a relationship and then they can sell me other products and services over time. But by not at least offering that, that creates a, dynamic where you're not going to build a relationship at all, right?
The mobile upload a check. We give you access to your capital faster and quicker than most firms would because we have all the information on you. And so as these events started to happen, we were able to show our board, to show the regulators the efficacy of our design. 90% of our deposits are direct deposit customers, which means they're sticky. It's not just hot money chasing an interest rate. And then 97% of them are insured. We provide $2 million of insurance through a separate program. We partner with somebody on top of the $250,000 that we are able to provide through FDIC insurance. So we supplement that through a partnership. So it actually amplified our differentiation in a way that we couldn't have paid for. And so we've had, more than $2 billion of new deposits each quarter, and the value prop is really compelling. And we continue to see the flywheel work in incredible ways, and people cross-buying to other products and driving down marketing efficiencies, et cetera.
And Andrew can talk a little bit more about this than I can, but because of the way you measure success, you use this concept of members, and as opposed to another concept, whether it's MAUs, DAUs, what have you. I think it's been a little bit difficult to break through to the financial community that only knows how to analyze using that lens. Andrew, would you say it any differently? I'd love to hear a little bit about that journey and why you decided to take it. Is that right, Andrew? Did I characterize?
I was really skeptical when I first started modeling Sofi, and I wanted to just look at app MAUs, for example, but the correlation was so much stronger on a total members basis with respect to like revenue growth than it was for these active members. Must mean that the lifetime is just so much longer on Sofi than I guess how we traditionally view consumer apps. Maybe Anthony, could you give us more color there?
Yeah. Okay, let me put it real simple. Okay, listen. Sofi's a bank. It's a bank. It is a very fast-growing bank, but it is a bank. It's an online bank, okay? Let's not confuse us, And banks have very strong long-term relationships with their customers. That's what
I lived in the social media world at Twitter, and I covered, Facebook and as a banker and other companies that used MAUs and DAUs. And when I joined the company and we were talking about our metrics, I said, listen, the reason why Twitter and Facebook created the thing called MAU and DAU was because they were trying to create a proxy for what future revenue would be. And if you didn't have an active user, then that user couldn't see ads because they were not active. They're not on the platform enough to insert an ad every 10 tweets or every 10 posts on Facebook. And so people created these monthly active users and daily active users as a proxy for that's a revenue generating unit in the future. And then we'll figure out what the average revenue is per MAU or average revenue is per DAU. And so they were proxies. And what I said to the team was, our actual product produces revenue. We don't have to add a revenue model on top of it. When someone opens a checking account and they put money into it, it's producing revenue as long as if there's no money there, it won't produce revenue. But our proxy is actually revenue. And revenue is the monetization vehicle where the engagement metric in the old world was MAU and DAU. Our engagement metric is revenue. And the best way to measure that is actual revenue per member or revenue per product. And so I didn't want our team to think that we had to create proxies for revenue, but that revenue was the engagement metric. And then ultimately the unit of revenue would be a member or a product.
Yeah, but it was met with such skepticism, which kind of surprised me, I mean, and it hurt your stock for a time, right? But I think sticking to something that you believed was true and is clearly playing out to be true was the right thing to do.
Anthony, you talked about a winner takes most market, but you also talked about category winners. So can you kind of help us reconcile like what you see as winners in like the horizontal digital wallet landscape? And do you see winners still existing in, let's say, like vertical niches?
I think in the horizontal sort of category, there's us, and I think there's the incumbents. Like I can't think of in the United States, a digital offering that has the product breadth that we have. I would say, Robinhood has a couple products and Chime has 2 products that we're both going after different demographic groups, but no one really has the holistic one-stop shop approach other than B of A and Citi and Wells Fargo and JP Morgan. And I'd say of that group, JP Morgan is by far the best. There have been times where I'm like, oh, they're not that good. And we've hired a couple of people from there and I've gotten to know more people there. And I'm like, they're pretty good. They're really good, actually. And they're good in a sneaky way. Like, I didn't even know that JP Morgan Chase offers brokerage. They have more brokerage members than we have. And it's kind of like below the radar screen. Do they do loans? They do, but only if you have a certain amount.
I have a brokerage account with Chase. It's not my main one, I can tell you that, but I do have a brokerage account and a little bit of money in there. So yeah.
Net wealth. So, the big incumbents, they're not going to go away. I mean, they have almost $1 trillion of deposits. They have hundreds of billions of dollars, but we're taking a little bit from all of them every day. And they don't even notice us because we're taking a little bit of all of them every day. I think the more vulnerable group is regional banks, credit unions, mom and pop things. And my analogy is to like Amazon. Amazon didn't go out and buy a bunch of bookstores. They just slowly took the share from the mom and pop bookstores. Now, I don't want that to happen in the banking industry. Most people, 50% of the people, when you ask them, they want a bank a mile from their house. And we want to help support those banks. But we can support them by giving them modern technology through Galileo and our tech platform. We can support them by selling them more loans so they don't have to worry about originating loans and building those businesses, which they probably can't do. And we'll help them survive and build the overall ecosystem. I do think that we can participate without putting those banks out of business in helping them survive and serve their local communities. And in doing so, get to the same scale as the Citis and the B of A's and the JP Morgans. Not to mention we're stealing a little bit of share from all of them along the way. In the category killer camp,
by the way, let me say this because I think this is important. Okay, he speaks about their, people want to be within a mile of their bank and those sorts of things. Okay, so my opinion is that's more of the older generation. I don't think the younger generation is going to care about that, just to be quite frank, at all. I think the younger generation, cash is irrelevant. Like they're never going to use cash. So they don't need an ATM. They don't need to speak to a banker at a branch or things like that. So I think for the younger generation, it's just pretty irrelevant for those folks. For older generation, that's totally different. If you're in your 50s and 60s and you're used to that, you want a physical branch that's close to you. If you're younger, I don't think you even care at all.
I do think a company like Affirm will stand for buy now, pay later. And it's at the point of checkout and it kind of has the distribution. They just have to manage credit appropriately, access to funds appropriately. It's not easy, but it ultimately is a model that can work. I do think they have to be a bank. I think Square completely owns SMB. Completely. Now, we will be a great SMB business as it relates to loans and checking savings account, but to truly do payment processing, merchant acquiring, that's their business. And to serve the underbanked with Cash App, that's their business. So they will continue to be incredibly successful. And I think Chime will be very, very successful. They're a big partner of ours. They have a very unique value proposition. They stuck to their knitting, which really, really was smart and not deviating out into other areas that could have killed them. So those are just a few.
And in terms of how SoFi evolved, starting with lending and into full banking services, can you comment on maybe a strategic advantage there in terms of the logical steps in product diversification? As in, was there a clear advantage starting from lending and then moving on to other services? Maybe it's harder to move from brokerage to other services and et cetera.
So the benefit of lending as being the first product is that there's massive LTV. If you do it the right way, the LTV that you have day one in lending is about $1,000, which is a huge return. And if you think about the dollar profit you get from just a digital wallet, it's, let's call it $100 first year, $100 second year, maybe it grows to $250, but it takes 5 years to get that same equivalent amount of LTV. So if you get that day one with lending, then you can actually subsidize the acquisition cost for the other products more prudently. Like the greatest advantage we had is that we had a huge LTV in the lending products. Now there's not as many of them. In our lifetime, we've only had 1 million personal loan products and 500,000 student loan products, but we have 11 million products. But that profit pool allowed us to fund the other businesses. Even today, we're losing over $100 million in credit card and invest because of acquisition costs and not covering our fixed costs yet. So lending is a big profit pool on a per person basis and a per loan basis. It's really hard to get right. You have to have the capital. You have to have the risk, the credit. You have to have the distribution. You have to have the financing. But it was a huge advantage.
And even from a lending CAC, you're far more efficient than, say, the legacy incumbents. How much do you attribute that to your marketing strategy? And how do you think about brand and performance marketing and I guess against incumbents and other neobanks?
Yeah, so I was presenting to our board in the beginning of 2019, and I said something like the plan for the year, and we were going to roll out SoFi Money, SoFi Credit Card, SoFi Invest that year, SoFi Relay. And I was really proud of that. We built it all. It's about to roll out. And I said, it's a matter of when, not if. And everyone's like, when, not if what? I said, we become a top 10 financial institution. They said, why are you so confident? Haven't you launched the product yet? And I said, we designed them to be the best. And they're going to be the best. We will not stop until they're the best. We'll run hard every day. We'll iterate every day. The only thing standing between us and actually getting there is building trust, is building a household brand name. So, there's a thing called unaided brand awareness. It's measured by asking someone the question, when you want to use a financial services product, name 3 companies. Well, when I got to SoFi, if you asked 100 people that question, 2 would say SoFi. And so I did an analysis of Citi, JP Morgan, Wells Fargo, Bank of America. There are between 25 and 45% of their brand. 100 people would say their names. I said, we have to become a household brand name like them. And if we do, our products will be top of mind and they'll be used. And it was literally at that moment that I said to myself, we got to do that damn LA stadium naming rights deal because it will instantly make us credible because the NFL. Also, I felt it was the most ambitious stage on the world and we'd have acts like Taylor Swift in the World Cup and the
boom. That's huge right there. That's huge, right? He's basically telling you the deal with SoFi Stadium, it was 100% just around credibility, right? Yeah, and it is. You to have such a big name stadium in LA like that is massive, and to have it be SoFi Stadium, right? And the traditional banks, one of the things that actually gives them a lot of credibility is the fact that you could go in many cities and you see there's the Wells Fargo building and there's the Chase building and then they're on the corner with their physical locations and things like that. Things like that might sound silly, but they matter substantially, subconsciously to people that, want to entrust that their money's with the financial institution.
In the Super Bowl and the college football championship. And so literally from that moment on, I focused the team on building unaided brand awareness first and foremost. Yes, we need to do performance marketing to drive acquisition and acceptable vehicle. But if our brand had high unaided brand awareness, then the performance marketing would be even more efficient. People would click on our ads more. We'd rank higher in search results, et cetera. So it's always been this 25% spending on brand awareness, unaided brand awareness, and 75% on performance marketing. And it's proved out to be a great strategy. And Lauren, our CMO, is just hit the cover off the ball. And we announced this week the official bank of the NBA as another step in that process.
We have something in common there. Last week, we had our Big Ideas Investment Summit here at the new Innovation Center in St. Petersburg, Florida. And I had the pleasure and the privilege of interviewing Andre Iguodala. And isn't that, and honestly, Anthony, I mean, when what happened was, I guess we were both in an airport somewhere, and he tweeted about it. But I mean, I didn't meet him. I didn't even know who he was. And one of our Matt Stout on our marketing team called out in the morning meeting, "Hey, did you know Andre Iguodala tweeted at you?" And I said, and everybody went, "Wow!" I said, "Okay, who is he?" You know, that's how terrible I am. And I'm into football much more than basketball. But we had the most amazing discussion. What a wonderful person he is. But do you know he's the president of the Players Association for the NBA?
Yeah, I think that's fabulous. Andre's a great person. He's obviously a great athlete, great teammate, but he's a great father and a great investor. I've gotten to know him out here in California. We belong to the same golf course, and we've had the pleasure of being together a few times and chatting about things from an investment standpoint to playing the game that we both love in golf.
Oh, that's so amazing. One other just side note here. I just have to throw it in because as an investor over the years, whenever I've seen a company.
I was not expecting Iguodala to get brought up in this one. Wasn't he the one that got blocked by James?
Invest in or get the naming rights for sports stadiums. I've been, And so, yeah, when I saw that, I said, but typically that has happened when they're flying high and there's a big ego related reason. It is not for the reason that you just described. So, I just wanted to put that out as a marker for anyone who uses that indicator to sell a stock. I think it has done wonderful things for you. So congratulations on that.
I was equally skeptical for a year and a half until I literally said those words. We have to become a household brand name. And I'm like, I got to go tell the team the deal they've been trying to get me to do for a year and a half, we actually have to do.
And what is your score now on brand recognition? You want to get to the...
Yeah, it's up to 7% from 2%. And that's, it's a huge increase. It's been higher and lower, but that's sort of the last 13-week average. And we track it and, it's been as high as 10, 11%. And when I started, it was at 2%. And the team is really, this is another classic example of like iterating and iterating and iterating. The first year we did the stadium deal, we didn't realize we had to actually advertise during the game when it was at SoFi Stadium. Because people would hear SoFi, they would do searches, but they didn't actually know what it was. And so I'm like, okay, we'll run an ad. In the second quarter, we run an ad. And then the funny thing is, before we did the deal, the board asked me, how do you justify the cost of this? How many accounts do you think you're open? I'm like, I don't know. They're like, why are you recommending it then? I said, here's my math. Right now, we spend about $20 million on the U.S. Open Championship, tennis, U.S. Open golf, Big Ten Conference Championship, Big East Basketball Championship, and ESPN X Games. And we only reach 15 million people one time a year on $20 million. Because I worked at the NFL, I know that this stadium will probably get 4 to 6 primetime games. And each primetime game gets about 20 to 25 million people. So one game is worth what we used to spend on all those other things. We'll stop doing that and we'll put the money to this and we'll get 5 times that amount from the primetime games. And the team really brought it to life because, you have, let's just say the first game of the year, Monday Night Football, is at SoFi Stadium. We run our ad. Next Monday night, it's not at SoFi Stadium, but the same audience comes back because they want to watch Monday Night Football. And so you're hitting 10, 15 times in a year, and it really has worked out well.
I have to throw in another story here about you that I just found remarkable. You became CFO of the NFL when?
2008, January of 2008.
January of 2008. And I remember you and I used to take the same train. We got off at the Darien train station from New York City. And so I used to see you regularly, and you had left our business. And I thought, what the heck? And I just didn't, conveniently, you skipped the 08-09 crisis and then went back to Goldman when? 2010 or 11?
11, yeah. I was at the NFL 8, 9, and 10.
So you even skipped the European sovereign debt crisis. Like, you have amazing timing. Anyway.
Better to be lucky than good.
No, that was a great call. Great call. Plus you had a lot of fun. NFL, right?
I did. It was a great experience.
So we talked a lot about core banking features with respect to building a one-stop shop. I think it'd be great. Maybe we can officially pivot the conversation to SoFi Invest, right? SoFi announced a pretty big product launch earlier this month, right? The launch of alternative investment vehicles, giving retail investors the ability to invest in venture, private credit, real estate, and other mutual funds. Can you talk about the process of building this product, main challenges that arose, and the road ahead?
Sure. In the big picture, we want to differentiate on a number of different vectors. One is fast, one is selection, content, convenience. And on selection and Invest itself, when we launched, the board was very skeptical about how we would differentiate and Invest, given there were so many incumbents and also many startups that already reached significant scale like Robinhood. And I said, well, we're going to have better selection, just like Amazon has better selection in books. And so they're like, well, how doesn't Robinhood offer all the stocks? I'm like, they do. So we'll have stocks without commissions, which they had. We're also going to launch fractional shares, which no one had, which we did and others have copied. We have 6 of our own robo accounts. We have our own ETFs. And then we started IPOs and now alternative asset classes. And crypto was another one of the selection differentiators. So my view is you should be able to buy anything you want in one place and not have to have 5 brokerage accounts and a cryptocurrency account, et cetera. And that's what's really been our differentiation. In terms of getting the IPOs, because I used to be a banker and we are a broker dealer, that was about just selling the value proposition of SoFi to these issuers. And it's gone really well. We're giving Main Street access to IPOs at IPO prices, and they never would have gotten that before. So it's been great for the partners and great for us from a member acquisition vehicle. On alternative asset classes, ARK, as you know, is part of the portfolio that we're offering. Many of the asset managers.
So let me be very clear. I think this is a really intelligent route they're kind of taking there. And I think his experience, obviously, at Goldman back in the day, I think he has a lot of connections there. And, can do a lot of interesting things in relation to ETF launches, in relation to IPOs, maybe not SPACs, because SPACs are kind of out of favor here for a bit. But I like that overall.
That the vast amount of growth over the next 20, 30 years is going to come from retail. It's about democratizing their offerings to reach a whole new audience that previously was only reserved for the wealthiest people in the world. And so it took both companies being willing to do that and our technology and technology partners being able to do it. It took us about 1.5 years to get the product built, to do all the integrations, get through the legal process and get it launched. But it's been a great success so far. We really have to give diversity of selection. We can't just offer 1 or 2. Otherwise you can, get in trouble from a recommendation standpoint. So we've launched with 6 different partners. ARK is one of them, of course. And we're very thankful and feel the privilege of having it on our platform. But Carlisle and KK.
Now it makes sense why this interview was going on. I thought it was kind of random that Cathie Wood was interviewing SoFi CEO here, but okay, now it all makes sense.
And Franklin Templeton and Clarion are other partners as well. So they're on the app. You don't have to have any minimum asset size. You can buy them right in the app. There's a minimum amount that you have to invest, but it's not that high. And what I've found is the performance. It's one of the few assets you can buy that actually has the performance right there at the point of purchase. And the performance has been really good for several of them and very attractive for our members. So it's worked out well so far.
And I'd love to just on the democratization. I agree with you. That's what ARK is all about. Democratization, transparency, and really giving away our research so that potential clients can understand how profoundly the world's going to change in the years ahead. So thank you for providing your wonderful platform.
I think it was about 1 year ago that we met at an Andreessen Horowitz conference and said, hey, we should do this.
Yeah.
So it's worked out well.
Yes.
Thank you.
Yes.
Democratization seems to be one variable disrupting private wealth. What do you think of AI? Generative AI, and how are you playing with it within SoFi?
I'd say at this point, we're using it more for providing great customer service. That's a natural language model that we use AI for. We use it to help power our member home feed. We're trying to answer 3 questions every day for you in the member home feed, which is what must you do in that day financially? What should you do in your life that day financially? And what could you do? The other place we're using it is on fraud and risk. And I think that probably has the greatest potential impact for the industry. If I go back to my e-commerce days in the late 90s, a lot of people wouldn't buy online after 2000 because when they did the year before, the product never showed up or you couldn't return it or it was the wrong product. And it took the whole industry to get better, not just Amazon, but anyone else that was in the business. And I think in the fintech space, we're only going to be as good as our weakest link. And if you put your money with a company and lose it all, the whole industry gets that black eye.
Yep.
And so I think generative AI is a way to really combat fraud, synthetic fraud, account takeover fraud, and really make the industry safe to operate digitally. And so one of the things that we do at our tech platform is we license payment risk platform. It's using AI to predict whether or not a transaction's safe. And we're only charging pennies per call of that technology, but it's really a consortium. We're using all the data that we have. We're helping people build algorithms so they can run the right types of safety modules they need to avoid, transactional fraud.
Whose platform where are you using, Anthony?
Our SoFi, so our tech platform, Galileo and Technisys.
Okay, your own. Okay.
We have about 8 billion transactions through our payment processing.
She's about to invest in whatever company. She's like Palo Alto Networks. She's like, okay, I'm buying it.
At Galileo, and so that gives you a lot of data that can help train the models.
Got it. That's great.
Yeah, I'd love to ask more about Galileo, and it's the AWS aspect to your Amazon analogy, but I think we are running low on time. So I just want to say this has been a really interesting conversation. Thank you so much, Anthony and Cathie, for your time and sharing your knowledge today. And we at ARC are very excited to see SoFi's growth from a leading challenger bank to a leading bank overall as the decade progresses. One final question for you before concluding the podcast episode. What about SoFi as a whole excites you most as you consider its product evolution over the next 5 years? And is there anything you'd like to communicate to consumers and investors for the year ahead?
I'd say it's still day one. And I know that's a term that Jeff Bezos has used a lot, but I've been here for 6 years. It feels like we just started. We're just scratching the surface with what we can do from an innovation standpoint, a data standpoint, what we can do to help people get their money right. And, we're just starting to do things like helping people budget better, helping them lower their cost of debt, really starting to come up with more solutions than just products. And I truly believe that if we can be the Facebook of your friends, the Twitter of your news, the business of LinkedIn, if you come to our member home feed and we can answer 3 questions for you every day, better than anyone else, what must you do that day? What should you do that day? What can you do that day in your financial life? We will help people get to where they want to go and to live the American dream. And so I still feel like even though it's been 6 years, it's day one and there's so much more innovation ahead of us. And I know there's never going to be a straight path anywhere, but I know that we're best prepared to get there than compared to anyone else.
With that, thank you again. And this has been another episode of For Your Innovation. Thank you all for listening.
So good interview overall there. I liked a lot of the points Anthony Noto really hit on there. I think that was phenomenal. And I mean, at the end of the day, people need to just understand SoFi is a bank. It's a very fast growing bank and it's a very tech focused bank, right? And so that's what differentiates it versus a Wells Fargo, a Bank of America, those sorts of guys, right? Those ones aren't obviously nearly as fast growing. They're not as nearly as tech focused, right? Versus a SoFi. But at the end of the day, this really needs to be thought of as a bank, a company that's acquiring a lot of customers. Those customers will grow their net worths over time. The company will be able to sell more products and services to those folks over time. And, it can be a very, very profitable business as the years tick on and go from, obviously being a money loser in the past to all of a sudden a big money maker, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. Hope you enjoyed today's video. And also, to get that workshop, it's free. Pin comment down there, folks. Enjoy that one. Alrighty, much love and have a great day.